We're now starting, we're having 2 academic sessions now, each centered around a particular academic study, very recent academic study, one on CBDC and banking, which is the first one now, and then one on design of CBDC. We're very excited about this. And I just realized an hour ago that maybe I should, because we are a mixed audience and you know, we have academics, we have professionals, we have students, we have people from the regulatory environment. And I realized that not everybody is aware how an academic session might work. I was like, oh, there's 2 people, but there's one mic, like they talk to each other, like how does it work? So let me just, and 1/3 of the room will roll their eyes now. Let me just explain how this is supposed to work. So there's a presenter, and it's going to be welcoming Yufeng from Urbana-Champaign to present the first paper. And she'll present the first paper, Central Bank, Digital Currencies, Disintermediate Banks. And then we'll have a discussant, which is going to be Alfred Lehar from the University of Calgary, who will take the stage after Yufeng, and we will discuss or critique. He has read the paper before and thought about it, and he will critique the paper. So it's going to be sequential, and then we'll have time for questions from the audience and discussion. And that's kind of like how academic sessions work. And then we'll, in the afternoon, we'll switch our mind and say, okay, let's have a discussion actually, where people actually discuss with each other on the stage. But for the rest of the morning, it's going to be academic in that sense. And I also have, which we'll do in academic sessions, I have this one, which is for the speaker. So 5 means you have 5 minutes. One is 1 minute, and you don't want to see that one. So that's how it works. And so without further ado, I'm very excited on our first topic session, which was already a little bit touched on by McGill's keynote just an hour ago. Very important question. The title says it all. Will central bank digital currency disintermediate banks? It's a joint paper, Tony Whitehead, and we're pleased to have Yufeng Wu from Urbana-Champaign here, and Chiron Xiao from Columbia is the core.
Okay, so first, well, I'll just do this. Okay, so first of all, thanks a lot for having me here and giving me this opportunity to talk about the paper, which is joined with Tony from Michigan and Chiron from Columbia. So in this paper, we're going to look at banks, and we're going to focus mainly on the cost side or the potential cost side regarding how CBDC is likely to influence banks. So an hour ago, we heard a lot about the motivations of having CBDC and what is the potential going forward. But unfortunately, that's not going to be the focus of this paper. So in this paper, we're going to look at, for CBDC, once it has been introduced into the market, how this is going to influence the bank behaviors, which I think is a very important piece that we need to understand in this whole argument of having CBDC. And this is our motivation for writing this paper. Okay. So before I start, I would like to first show the map that tracks the introduction of CBDC globally. So by yesterday, while I was updating my slides, we have, I'm not sure if you can see this small numbers here. We have 11 countries who have already launched the CBDC, 15 countries who have already had some pilot program, 25 countries who are developing, and another 45 countries who are actively researching. And the amazing thing is every time when I present this paper, I need to go back and revise the numbers because the numbers keep changing all the time, which also highlights how fast the CBDC is developing. But at the same time, this development of CBDC is not without concerns. So for example, we have this argument by the Federal Reserve saying that the wide availability of CBDC could reduce the aggregate amount of deposits in the banking system, which could in return increase bank funding expense and reduce the credit availability. And following the same line of thinking, we have more severe concern expressed by the president of the Bank Policy Institute. And he argued that given that the average loan to deposit ratio for banks is generally around 1-to-1, that means every dollar that migrates from commercial bank deposits to CBDC is going to imply $1 less of lending. So in this paper, our goal is really we want to revisit this comments on the disintermediation effects of CBDC and see to what degree the introduction of CBDC is going to influence the banking system. Okay, And to do this, we start by building a quantitative banking model where we have imperfect competition among banks and between banks and other products, for example, the ones offered by the central bank. And in the model, we also have the banks facing some regulations and financial frictions, which I will discuss later. And as a second step, we're going to estimate our model using the data based on the existing US banking system. And there are two important things that we want to estimate here. So first, we want to estimate the household's demand for private versus public money creation. And to do that, we utilize the classical techniques from the IO literature. And after that, we want to estimate how costly it is for banks to perform their operations and what degree of financial frictions they are facing while performing these operations. And combining the estimation strategy in this way is very important for our purpose. Because by the first step, by quantifying the household preference, we're able to get a sense of the CBDC once it is introduced in the market. How much of the deposit it is likely to crowd out. And second, by having the second step, namely quantifying the bank side parameters as well as the financial frictions, we're able to track how this lost deposit will translate onto banks' lending decisions. And lastly, once we're equipped with all these estimates, we're going to counterfactually add CBDC into the model and see how it is going to influence the predicted bank behaviors. And while doing this exercise, we want to make sure that the way we parameterize CBDC is realistic and quantitatively relevant. But on the other hand, this is really challenging because we know the CBDC has not been fully introduced in most advanced economies, including the US. So we are going to get around this challenge by again relying on the IO techniques. Basically, we're going to follow the structural IO literature and we'll conceptualize CBDC as a new bundle of some existing characteristics. So we're thinking that although CBDC is a new product, but the feature associated with CBDC are not something that we haven't seen before. And in fact, we can quantify what is the household's valuation attached to these different features in our second step. So once we do that, we're going to collect all these different features, create a new bundle out of it, and we're going to label it as CBDC, introducing that into our model and see how things will change. Okay, so this is the roadmap of my presentation today. So next, I'm going to just jump into the model. I'll give you a summary, and I will highlight some features which are important for our qualitative and quantitative predictions. Okay. So in our model, we focus on three groups of players. We have the depositors, and they make a simple intra-period decision regarding where to deposit their household wealth. We have the borrowers, and again, they make a simple intra-period decision regarding how much to borrow and whom they want to borrow from. And lastly, we have the banks. So this is where the richness of our model lies in, because we allow the banks to make a dynamic optimization decision regarding what is the rate they want to charge the depositors and the lenders, as well as what is the optimal capital structure over time. And in our baseline model and estimation, we are not going to include CBDC because we're matching the data corresponding to the current US banking system where the CBDC has not been introduced yet. But once we have the model estimates, we are going to counterfactually introduce CBDC into the model and see what's going to be the implications coming out of it. Okay. So first, let me describe this deposit market where we have imperfect competition among J banks. So the banks are going to compete among themselves. At the same time, they are going to compete with potentially the product offered by the central bank. And for each bank, it is going to offer two products, a savings and transaction deposits. So that counts as 2 times J options because for each bank, it is differentiated, and that's why its product is counted as a differentiated investment option. And the household can also invest in cash or an outside option corresponding to holding short-term bonds. And the household, they are going to choose among the different options in order to maximize its utility from the deposit market. So, which looks like the following. So first, he's going to derive some utility from getting the rate of return from this product, which is the part that's highlighted in red. And in addition, he's going to derive some utility from the quality of this product, which is really just a linear combination of some non-rate features. For example, if you invest in a commercial bank product, what is the number of branches in a local neighborhood? What is the employees per branch, and so on and so forth. And second, it depends on what is the issuer fixed effect. So are you holding something issued by a commercial bank or the central bank? And third, it depends on a transaction convenience dummy, which equals to 1 if we are talking about transaction deposits, cash, or any digital currency, and it's going to be 0 for savings deposit and short-term bond. And lastly, it depends on whether this product is supported by a digital platform. Okay. So in addition to these, the household's utility from the deposit market is also going to depend on the last epsilon curve, which is really a match-specific preference shock. Okay. So for example, holding this rate of return and quality constant, I'm more likely to deposit with JPMorgan Chase if there is a loan officer that I really like, or if the bank has a branch in a local neighborhood. So that is interpreted as me and JPMorgan Chase has a really high match specific preference shock. And as a result, I'm going to perceive this bank differently from the others, which allows the bank to have a market power. So the bank can increase the pricing to above its competitors without having to worry that I'm going to lose all of my customers at once. And here, one important observation that I want to make is for the households, in reality, they differ in their sensitivities to this rate and non-rate characteristics. We have a long literature about that. And this is how we model it in this model. And it's important because it allows us to generate very rich substitution patterns. So for example, if we have an interest-bearing CBDC, that means it's going to compete more intensively with the high interest rate product as well as the high interest banks. And this is because for both the interest-paying CBDC and the high interest rate bank, they are likely to appeal to the same group of depositors or clients who are interest sensitive. And because they share the same clientele, so ex post, there's going to be more intensified competition between them. So next, on the loan market, we have the same set of J banks. And in this plan, they are competing for potential borrowers. And for each borrower, he can choose to take a loan from one of the J banks, issue corporate bond, or not to borrow at all, in order to maximize his profit from this loan market, which equals his rate of return from borrowing, which allows him to make investment, minus any issuance cost, minus the interest rate charge. And here again on the loan market, we have this epsilon in this profitability function, which captures the impact from the firm-bank specific relationship. And for banks, they are going to set their interest rate for transaction and savings deposit, as well as for their bank loans. And once we have this manual of interest rate from the different banks, we're going to impose the standard assumption that this epsilon, which is the match-specific preference shock, is going to follow a typical type 1 extreme value distribution, which allows us to aggregate the quantity demanded for deposits and loans from a specific bank, okay, which takes the logic form. So as we can see from a bank's perspective, after I post my interest rate, so my market share is going to depend not only my own interest rate, but also the rate posted by my competitors, as well as the design of the CBDC if it has been introduced in the market. Okay. So now, aside from this deposit and bank loans, there are other things on the bank's balance sheet, which we also incorporate in the model. So first, on the asset side, the bank can also hold reserves and government securities. And on the liability side, if the amount of retail deposits and bank capital are not sufficient to support the amount of lending, the bank can also borrow non-reservables, which is not subject to the reserve requirement but at the same time is not insured. Okay. So every period, the bank is going to choose their pricing as well as this many balance sheet variables in order to maximize the discounted cash flow to their equity holders. And the bank will default if the V falls below zero, the valuation falls below zero. Okay. And while doing this, the banks are facing the regulations, which says at any given point in time, the bank reserve has to be higher than a given fraction of the retail deposits. And at the same time, the equity has to be higher than a given fraction of the risky bank loans. Okay. Banks are also facing financial friction, which is most relevant, especially if the bank needs to go to the wholesale funding market, because retail deposits are cheap and wholesale funding is much more expensive. And the cost has two elements. So first we have this exogenous cost that captures the cost associated with search and maintain your relationship on this wholesale funding market, which we capture by this exogenous fee function. And second, there is this endogenous risk premium because it is not insured, and as a result, the lenders on this market, they need to charge a premium to make sure that they break even. And lastly, we have the maturity mismatch, which is modeled in a standard way, where bank deposits are 1 year and loans are long term. And at any given year, the outstanding bank loans might face a delinquency shock. Okay, so here's the model. And one observation I want to make here is, without any of these frictions that I list here, the banks are just going to operate independently on the deposit and loan market, meaning that on the deposit market, they are going to make decisions. They take cheap retail deposits and invest in the securities market. On the loan market, they are going to borrow non-reservables and they use the proceeds to support the amount of bank lending. However, with these different frictions, it serves to connect the deposit and loan market, and as a result, any interruption to the deposit market is going to be transmitted onto the bank's lending decisions, which is what we aim to capture here. Okay, let me summarize the model solution by saying that we're solving for equilibrium, where banks make their optimal decisions, and at the same time, they anticipate what the other banks are doing on this market. Okay, so now we have the model solution. So next, we're going to go ahead and estimate our model. And here we divide our estimation into two stages. So in the first stage, we're going to estimate the deposit and loan demand using this classical technique in the IO literature. Basically, it allows us to back out what are the household sensitivity to the rate posted by different products on the deposit market. Really? And also, what are the value attached to the non-rate characteristics? I'll hurry up. And in the second stage, we are going to estimate other important parameters on the bank side, including how costly it is for them to perform operations and what is the degree of financial frictions they are facing. And here we are going to choose our parameters in a way that, so first, with some parameter inputs, we're going to solve the model, simulate some banks, and calculate some important features. And we're going to calculate the same set of important features using the actual data, and we choose the parameters so that the model predicted features match the reality as closely as possible. So this is how we pick the parameters. And here's the result. Let me just summarize by saying that, so we are able to match all the important valuation, pricing, and balance sheet variables. And especially we're able to match the bank's wholesale borrowing ratio as well as how this ratio varies over time. So now with the estimates, next what we're going to do, which is the most important part, is we're going to introduce CBDC into the model. So before that, I need to first describe how we conceptualize CBDC, which is not a trivial task, given that there is a wide range of flexibility regarding how this can be implemented. Okay? So in our baseline model, we're going to conceptualize CBDC as a bundle with the following features. So first, it compares on interest rate. In our baseline, we're going to set interest rate to 0, but we are also going to consider cases where the Fed starts to offer interest rate on CBDC. So second, it offers transaction convenience. it has the same issuer fixed effect as cash because it's issued by the central bank. And lastly, because it's a digital currency, so by definition, it's going to carry a digital premium. And although this seems like a very intuitive starting point, we also realize that there is a huge uncertainty regarding how the households is going to perceive the quality of the CBDC exactly. And in order to deal with that concern, what we're going to do is we're going to vary the parameter that captures the quality of the CBDC. And we want to calculate how much market share CBDC is going to capture under different cases. And then we calculate what is the sensitivity of bank behaviors with respect to this market share, which allows us to make conclusions such as if the CBDC holdings increase by $1, what's going to happen to different bank behaviors, for example, the deposit and bank loans. How much cents of deposit or bank loans this $1 of CBDC is going to crowd out. Okay. And here's the result. So first, we'll consider CBDC that does not bear an interest rate. Okay. And from the result, we can see that even without interest rate, the CBDC can take approximately 8% of the deposit market, which is quite substantial. And $1 increase in CBDC is going to decrease transaction deposit by 64 cents and savings deposit by 10 cents. But at the same time, the impact on bank lending is quite muted. So $1 increase in CBDC only brought up bank lendings by 19 cents relative to the quite substantial impact on the deposit market. Okay. So next, we're going to see what happens behind this 19 cents. What is the channel that drives this result? Okay. And due to the time limitation, I'm just going to mention that. So the main channel operates through this deposit quantity. So once the CBDC is introduced on this deposit market, it's going to crowd out cheap deposit. As a result, the bank will have to switch from the cheap retail deposits to more expensive wholesale funding on this expensive margin. And that channel alone is going to predict that $1 increase in CBDC is going to crowd out lending by 15 cents. But in addition to that, CBDC can also influence lending by changing the credit spread that bank needs to pay on their wholesale funding, and by changing the bank's profitability, which determines how easy it is for the bank to accumulate bank capital. These other channels are not as important as the first one, but they are also quite substantial. I'm running out of time, so let me just summarize the second result, which is on interest-bearing CBDC. When CBDC starts to pay interest rate, then we find that if CBDC pays an interest rate that equals to the short-term federal funds rate, we find that it is going to take an additional 26% of the deposit market. At the same time, another result is for interest-paying CBDC, it's going to crowd out savings deposit much more substantially than what we had in the previous case. Well, and the reason is because with interest-paying CBDC, it's going to behave more similar to the savings deposit. And as a result, the CBDC and savings deposit, they are likely to attract very similar clientele. And that's the reason why they are going to compete more intensively, and we see a much larger crowding out effect. But despite this differential substitution pattern, the impact on bank lending, it's still quite muted. Okay, we can see that it is still less than 1/3 of the impact that we see on the retail and transaction deposits, on the transaction and savings deposits. Okay. So now I can come back to the question that I asked at the beginning of the presentation. Will CBDC disintermediate banks? Well, based on the findings so far, the answer is not so much. Okay. But of course, the magnitude, just one more minute, can also vary a lot across different banks. So we discovered that for $1 increase in CBDC is going to crowd out the credit provision from small banks much more substantially because they face much higher cost of access wholesale funding. And it is also going to have a more substantial impact in a more competitive market because the banks are less capitalized and find it harder to adapt to this competition shocks introduced by the CBDC. So the takeaway from this result is the CBDC is likely to have quite modest impact in terms of disintermediating banks on average, but there can be a relatively more important redistributional effect. If we are concerned that smaller firms are matched with smaller banks, and that they are likely to be hurt more in terms of the reduction in credit provision after the CBDC is introduced. Okay, I think I'm running out of the time. I'm going to see the zero, so I'll stop here, and I'm looking forward to the discussion.
Discussion is Alfred Lehar from Calgary.
Okay, thank you. Thank you to the organizers for having me and for allowing me to discuss this very interesting paper. So I'm not really using a microphone very often, as you can tell. So let's see how that works. Okay, so let me start by summarizing the paper and tell you a little bit about the key players in the model. So these are households. They can choose between transactions or savings deposits, cash, bonds, or CBDC, and they have $1 and they have to choose one of these options. And each of these options has a different yield, different characteristics. There's a fixed effect and a shock to these preferences, and all the households are different and have different preferences. There's also firms who can choose between long-term bonds or bank loans or not to borrow at all. And again, they want to borrow $1 and they have to choose one of these options. They also have a lot of variation between them. They have different geographic locations and industry expertise. They have yield characteristics, fixed effects, and they also have a shock to their preferences. And all the firms are, again, somewhat different. The main action of the paper is with the banks, where there is some federal funds rate that the banks assume is given. Some fraction of the loans fails, some bank loans get repriced. There's various costs that are linked to deposits, loan provision, there's fixed costs. The banks accumulate profits, pay taxes and dividends. It's costly to adjust the dividends, and it's also costly to raise equity for these banks. So the banks try to maximize their future value, and the federal fund rates follow some exogenous process correlated with loan losses. The banks can default, there's bankruptcy costs, and the proceeds of the banks are sold and the bank gets restructured. Okay, so if we bring this model to the data, there is some interesting insights we can learn from this. So CBDC forces banks to pay more on deposits. The bank value goes down. As these bank deposits increase, there's not so much an impact on bank lending because the banks can switch to wholesale deposits. So if the banks have fewer retail deposits, they can substitute that with wholesale deposits. So the impact on lending is not so strong. Obviously, these effects are stronger when the CBDC pays interest, and there's some interesting implications in the model in terms of being more, the bank funding costs are more sensitive to the Fed funds rate, that the smaller banks are more affected as they pay higher wholesale funding rate, and CBDC could potentially increase financial fragility because the banks are less profitable, and so they have a harder time to recover from the financial crisis. So as discussant, it's my job to give some comments for the paper. So first of all, what I really like about the paper is that it allows us to give us some more rigorous predictions of what will change in banking with CBDC. Specifically, we can get really some numbers and see how does the introduction of a CBDC affect deposits and affect loan provision. So for me, I just found that there's a lot going on in the model. There's a lot of assumptions and in the paper, and I had a little bit of a hard time to understand what are the important assumptions that drive the results and what are kind of the innocent assumptions that don't really matter and just are useful to match the model to the data. So the key exogenous variable, for example, is the Fed funds rate in the paper, and that follows pretty much a random process. And since we have some central bankers in the room, I don't know how we should think about that, but maybe this is true, but maybe there is some other considerations that come into this, and like welfare, financial stability. Specifically, what I think, if we think that the CBDC impacts monetary policy transmission, the central banks might adopt the monetary policy after the introduction of CBDC. So assuming the same kind of process for the Fed funds rate in the presence of the CBDC might not be totally accurate. So in some way, I would like to see a little bit more about how does the CBDC add value? How is this special? So at the moment, CBDC is more or less just a good, another way that households can use to make payments and store money. So to put this a little bit, push this to the extreme case, if you all agree that tulip bulbs are the way to buy goods and store value, then tulip bulbs would be similar in the model to CBDC. So there's no extra value that comes from the CBDC. So if we think that this generates some value for society, I think it would be interesting to include that in the paper, because it would affect certainly households and also firms that are part of this model. So we could think that this allows new forms of contracting or some kind of innovation that makes everybody pay off. CBDC could also affect businesses, which is not part of the model at the moment. So businesses could save costs with automation, or just plainly reduce cash handling costs if we have now this form of digital payment. So CBDC could potentially also change competition. So fintechs could enter the market. So my son is already banking with a fintech, and I'm just still waiting that my old bank issues me a credit card where I can actually read the numbers. So there is ways that this might change product market competition. Banks might differentiate. And so in the model, that the number of banking licenses, as far as I understand, in the economy is kind of constant. So banks might also shift their business model. They might introduce wallets and custody handling, collect fees for that, and so that might change banking by itself. The maturity structure of that could change, and also the type of financing that firms use might change. So if we are a CBDC app store, I can download a bond smart contract that might make bonds more accessible for small firms, and probably that's never going to happen, but who knows? And so just CBDC itself and programmability might open up the bond market for different types of firms. And if you think about CBDC might also change what banks are really doing. So in the model, banks produce loans and deposits, which are mainly a function of the interest rate. And so if you think about two dimensions, for example, that are important for banking, one could be potentially risk. And so the question is, when we look at excessive risk taking, that's certainly a problem in banking, and that could lead to big financial crisis. So CBDC could again change how risk taking in banking works out. So we might face more depositor discipline as CBDC allows depositors to quickly withdraw their money and convert it into a central bank safe asset. CBDC might also incentivize banks to take on more risk, or as firms now, some smaller firms access the bond market, it might just change the composition of the bank's asset portfolio. So I think that this will have a more fundamental impact on the way banks operate. A second channel might be information, for example. So banks' payment flows, and that your bank can see what are their customers paying, what money do they receive, what payments do they make, is an important source of information. So for the banks to make loan decisions. So CBDC might reduce that information flow. or it might increase information flow if some of that information is in some pseudonymous way public on a blockchain. It's unclear at the moment how this will turn out. It might allow customers to selectively reveal to banks information that they want. I could go to kind of a distributed ledger and say, and make the conscious decision to share all my past transaction history with a financial intermediary. So all of this change in information environment that comes potentially with CBDC will impact the value of banks and therefore will change the bank's decision. And finally, as banks change because of the introduction of CBDC, so will bank regulation. Hopefully bank regulators don't just leave everything static as it is and will adopt regulation as banks change. And this might have an impact on how banks will behave and how much future lending and deposits will be affected by the introduction of the CBDC. So the last point is just some minor comments that are not terribly important, but in the model, banks are forced to pay this long-term level of dividends with these adjustment costs, and that might not be in the first best interest of the shareholders. So I wonder where these adjustment costs come from and how we could potentially overcome that to really create some shareholder value here. And if there is potential adjustment cost, if banks can stop paying dividends, maybe they will become more profitable, and maybe some of these frictions that come from banks defaulting could be mitigated in this approach. So banks could merge and split, and I'm sure that the introduction of CBDC and the changes this brings to the economy will certainly affect how banks operate and how many banks we'll see in the economy. And my time is up, and thank you so much for allowing me to discuss the paper. I really enjoyed it.
We have a few minutes. Maybe I would suggest, rather than Yufeng responding to Alfred, which you can maybe in the break, that we take a few questions instead before we go into the break, and then you two can air it out. Coffee. Thomas.
So yeah, I think it's a very interesting exercise to show how CBDC can crowd out bank deposits. Natural question: if we see this as an issue, given that bank deposits are already somewhat subsidized, could the central bank resolve this issue by simply lending CBDC at subsidized rates to the banks? And would you foresee any issues with that, or would you see that as sort of a clean solution if we do indeed see this as a problem?
Yeah, should I get questions first and answer them one by one?
Maybe one by one.
Oh, okay, great.
Quickly.
Okay, I'll try to give a brief answer. I think, first of all, I think that's a great question. Actually, we have some discussion in the paper that I ran out of time, so I don't have time to cover that. So first of all, our result is it is going to crowd out deposit, but actually it's not going to influence the banks that much. So that's the takeaway. The second is there are some issues with the smaller banks for sure. So what should the central bank do? Can it lend back to the commercial banks during normal times? There are some regulation barriers to overcome in that regard. That can be a solution. But in addition, we have some other discussion in the paper which says instead of doing that, like this period by period short-term lending, we should also consider, the central bankers should also consider changing the term structure of the lending to make the rate more similar to what if in a situation where the banks would have got by directly having this funding coming from the retail depositors. So that is some solution that we want to consider for sure. Is that a clean solution? I think people in the audience are in a better position to answer this question than myself. I don't think it's going to be a clean solution, but that's something that we should consider for sure. Yeah.
Thank you for the presentation, Yufeng. So I have a small question about your model. One of the things you mentioned that if there's kind of no additional frictions in your model, then there's kind of this disconnect between the volume of loans and the volume of deposits, which is very much like what David and Desautels was also financing in this model. But then you introduce these additional frictions, which basically make lending volume and deposits connected. And one question that I wondered about is like which frictions that you introduce are most important to create this connection between lending volume on one hand and deposits volume.
That's a great question. I think which one is more important, it has something to do with which outcome we're looking at. If you're looking at this transmission from deposit market frictions to the lending decisions, then this external financing cost and the credit spread are the important things. Because now you have to shift to something that's more expensive to finance the loan summer margin that lowers the incentive for the banks to make loans. So for that result, this is the most important friction in the model.
Thank you.
Thank you, Yufeng. Yeah, this paper will be very useful for many of us looking at this seriously. But one part that we're considering very carefully is the involvement of banks in the ecosystem of CBDC. So here banks are basically having different business lines, but they don't have strictly complementarity between them, right? So one might wonder that if banks are the distributors of CBDC, maybe the balances shift, some of the balances shift to CBDC, but the customer relationship stays the same. So can your framework be extended to consider the complementarity of different business lines, and what would be the overall effect on bank profitability?
Yeah, that's another great question. Actually, we are thinking about, in the paper, we have some discussion where we talk about this intermediated version of CBDC. I mean, what kind of, what amount of subsidy that you have to give the banks in order for us to not see this large impact on banks' equity capital and things like this, things like that, especially during the crisis times. That's something that I think we should consider for sure. So, which is having an intermediated version. But then the one concern is once you have that, is maybe it's going to lead to even more severe redistributional effect. Because now instead of interrupting this bank customer relationship, now you are strengthening this relationship because the CBDC will also have to be intermediated by these banks as well. So that's not a clean solution per se, because again, there is this trade-off between what happens to banks versus what happens to sort of the equality across the bank customers.
Maybe a last one here.
Yeah, a couple of quick questions. First one is, what happens to the banks, the central bank balance sheet? So there was an 8% substitution for deposits. What's the substitution for cash? And the other one is, in your model, the banks have to find the deposits to be able to make a loan. But these days, you hear a lot more talk about more of a credit creation version of banking and money, so that banks just put the money, create the money, put it in your deposit and money from there. So what would that setup due to your story?
Great question. Those are two questions that I don't have an answer for now. But what I can say is, in order to address that question, first of all, regarding the central bank balance sheet, we need to have like more of a GE framework in order to address that concern, which is going to make the model even more annoying to read. But that's something that we are trying for sure. And another thing is regarding this, what was the second question, sir?
More of a credit creation.
Oh, more of a credit creation, yeah. So what we are doing right now is, I think, now what you see is more of like an average impact, how this is going to influence if there's a representative banking economy, and we know such thing do not exist. So what we do is we need to see what happens to banks, for example, who are more reliant on this deposit to create bank loans versus those who are less reliant, and see, like what we do with the big and small banks, what is the differential impact across the two groups, and that's going to give us some intuition regarding the question that you asked.
I'm tempted to keep going and going, but I know that the clock is one of our friends, so maybe Katrin, the last question. You interested still?
Wait, you have time?
Yeah, we'll do it quickly.
Yeah, okay, so related to one thing that Alfred said, among many other things that can change following the introduction of CBDC, But also when things will not be changing so much, it seems that in your setting, it's only possible that lending goes down and you're telling it's not that much. But even if you think of including existing things like lending club which are raising money differently or other sort of fintechs that get bigger, it is not impossible that lending can go up in the overall economy, whether it comes from banks or not, so what's your take?
Yeah, that's a perfect question. I want to take maybe 2 minutes to answer, although you said I need to keep it short. So first of all, changes in the model, what we consider is the lending changes and as well as the rate setting will change. Because now they are facing more intensive competition from the CBDC. So the bank will have to do something. They'll have to offer, for example, better rate if they want to attract more depositors. And given the framework, we can actually calculate if we take a partial equilibrium view, what's going to be the welfare consequence? Because we have set up the utility and then profit and things like that. And I want to say one more thing, which is regarding what's going to change. I think what is really interesting is maybe in the future, because they are facing this competition, not just the rate setting will change, the technology will also change. Because I think the banks, they might have incentive to provide something that's more appealing to the customers, which is going to change the environment overall. That's not something that we can capture in this model. And but I think it's likely to be something that will happen in the future. So what I can say is we just take this partial equilibrium view as a starting point to see if nothing changes, what's going to happen to the bank strategies. But at the same time, I think it's very likely that the technology it's likely to change in the future to make the bank services better, which is another sort of positive consequence of having the CBDC in the market.